Okay, looks like attendee numbers have stabilized, so we'll start. So again, thank you everybody for joining. Welcome to the TI Upply and IRU European Road Freight Rate Benchmark for Q4 2024. We're pleased to welcome you all again for yet another webinar to take a look at road freight rate developments and developments in the wider road freight market. It's been an interesting quarter, of course. I think the big thing that's changed most of all has been on the political side, really, and we see a new president taking residence in the White House. You wouldn't normally think that would affect the European road freight market that much, but in this case, there may be some consequences for that. So, today we're dealing with the potential fallout from potential tariffs on the EU and on the UK, as we're seeing in the Americas, tariffs already being put in place. So perhaps we can talk a little bit about what some of the implications may be of that. Obviously, our expectation of anything like that would be lower demand and lower transit of goods. But there may be some second and third order effects of that, where if there are just differences in tariffs being imposed on different countries, we may find that countries very affected by tariffs may be dumping large volumes of slightly cheaper goods in European markets. It's all quite unclear at the moment, but we'll try and actually shed some light on that. And of course, we still have all of the ongoing European homemade developments as well of a fairly slow and stagnant economy, and lots of changes as we push towards net zero and push on with green ideas with new tolling and new fuel types, which we're going to be discussing today at some length. So welcome to everybody, and thanks very much for joining us once again. Now, it's time for me to introduce our panelists. So I will just come over, to introduce the four of us. So I'm Michael Clover. I'm your host today, and I'm TI's Head of Commercial Development. And for those of you who don't know Transport Intelligence, we are a research and consultancy firm dedicated to the logistics industry and providing insights on the strategic development of the road freight, contract logistics, and air and ocean freight forwarding markets. And I'm also joined by my colleague, Nathaniel Donaldson, who's our data team leader and an economist at TI, who's instrumental in providing the analysis for this report. So welcome, Nathan.
Thanks, Michael. Hello, everyone. Pleasure to be here.
And before I introduce our other panelists today, I also just should read out our disclaimer. So we remind you that all discussions and statements made by participants on commercially or strategically sensitive information may fall within the scope of competition law and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussion, including during breaks. So that done, I will also now introduce Marianne Savoni, the Associate Director of Strategy and Market Intelligence at IRU. Marianne, would you just introduce yourself and IRU for those who don't know the organization yet?
Yeah, sure. So good afternoon to all. So briefly, IRU is the World Road Transport Organization. We represent commercial road transport sector globally. We count a large diversity of members and partners. We have national road transport associations, large logistics companies, service providers, shippers, and also financial institutions. So briefly, what we deliver, we advocate at regional and global levels. We manage and we develop solutions to support the international transportation. And we develop intelligent services such as regulatory monitoring, fuel prices by type of energy, decarbonization intelligence, driver shortage, total cost of ownership. So just to give you some examples. And all the data I will present today are published on IRU Intelligence Platform. Thank you,
Thank you, Marianne. And before I introduce Thomas, I should probably also do the little housekeeping that I missed at the start there, just to say that the webinar presentation itself will last for about 35-40 minutes or so. And then we'll move on to a Q&A session. So please feel free to ask your questions in the Q&A app via Zoom as we go through the webinar, and we'll answer as many as we can at the end. Also, please do bear in mind that everyone will be sent a copy of the report and a recording of the webinar afterwards, so that you'll be able to review and read in detail about everything we're discussing today there. So please don't worry. You'll get that sent over as well. And we'll also be running a poll around the main benchmark. So please be prepared to participate and give your views on your expectations for rate developments during that poll. Okay, good. Right, now, finally, I need to introduce Thomas Leroux, Chief Executive Officer of Upply. Thanks for joining us again, Thomas. And could you just introduce yourself and Upply for those who don't know the organization?
Yeah, for sure. Thank you, Michael. So I'm the CEO and co-founder of Upply. Upply is a tech company that is dedicated to the supply chain industry. we are building application in an AI agent that helps customers that we have, freight forwarders, shippers, third party, also 4PL or consulting firms, to optimize and to automatize the supply chain, and more specifically the transport operations. And this is why we are collecting a lot of data in the transport operations. And here today we are focusing on the price of these operations in road transportation especially. And this is the data that you will see that is directly coming from Upply and from the invoices that we are collecting.
Of course. And we'll now move on to our methodology slide. We always get lots of questions around the data that all comes from Upply on rates. So could you just give us an overview of the methodology as well, Thomas?
Yeah, so at Upply, we build a lot of different applications, but one of these applications is taking all the data that we have and look directly at the evolution of prices. Here we will directly in this webinar look at full transport FTL, full transport in road transportation. With general cargo, we do have data also on temperature control or orders, but here this will be FTL, general cargo. We will have prices also for spots and contractual prices. The fuel is included. You will see also a part where we are directly tackling the fuel part and the evolutions. And this is the main idea. So transactional prices from real invoice. This is important. This is not just some answer of tenders. This is real shipment that happen. And we will look today FTL, general cargo, spot and contract, and the fuel is included.
Thank you very much. Right. Well, we'll move on to our first content slide now. So this is our overall European benchmark that looks at the development of spot and contract rates in an index. And before I just invite Nathan to give an explanation as to the overall development we saw in Q4 and the overall picture of European road freight rates, I'll also be opening up the poll in the background. So while Nathan's talking, you can also be giving your views and sharing your insights. So Nathan, could you take us through the overall picture in Europe, please?
Sure. Thank you, Michael. So yeah, as we see here, the European level indexes for both the spot and the contract markets. And if you're looking at the short term, the quarter on quarter, it's the contrast to what we saw in the previous quarter. This previous quarter, both indexes fell. This quarter, both have increased. If you look at the actual changes in the index, we see that the contract index moved further above spot, so the gap between the two indexes have widened. Of course, this is an index. It doesn't represent actual euro prices. It represents a change relative to the base in quarter 117. But we have a spot index that rose 2.8 points quarter on quarter to 128.9 in quarter 4 2024. But they do remain down 1.4 points. So the spot index remained down 1.4 points year on year. And that was as a result of some quite consistent rises in the first 9 months of 2024. Now, if we look over at the spot index rather than the contract index, we see that spot rates have increased just 0.5 points quarter on quarter. That's to 123.9. And they also sit down 1 point year on year. And that's as a result of a larger, longer, shallow, gentle decrease in the spot index. If we look at what this means for the story in the market, we see that low demand and cost pressures have allowed rates to settle somewhat at a higher level than the previous few years, but a lower level than the recent spike that we saw in 2022. We see that demand pressures are really kind of weak, but at the same time, we have costs and really low profit margins that appear to be causing some increase in volatility in the short term. So as a result of carriers that are seeking profits in a low demand environment, there's a high competition environment on the supply side. And so it means that those changes in costs are resulting in some more volatility in the short term. However, overall demand is reducing less pressure on the rates. And if we look on that kind of more medium term, we see a more flat experience than what we've seen recently with some large rises and some large dips. So we talk about the actual demand environment that's affecting the picture. As Michael mentioned, it's generally quite a sluggish demand environment in Europe. So it's causing very little upward pressure from demand on rates. And the Europe economy remains largely stagnant. So we've got GDP growth of just 0.9% in the previous 2 quarters. So it's allowing, it's not causing any significant short-term rises in the market. And I think we really see that as if we look at the overall trend of the spot market, it might just be about bottoming out now, but it has been on a steady fall. So that demand side pressure is not going to cause any significant increase in rates. We do see that smaller profit margin and those elevated costs have resulted in some increase in that contract market. So if we look at the actual indicators, seasonal volume growth for retail volumes were up 3.8%, so they facilitated some Q4 rises. However, if we remove that seasonal effect, we see that the volumes for retail are down 0.8% year on year. So we've still got a weakening demand environment. And if we look at production, production volumes are also falling. So they fell 0.3% quarter on quarter, and that puts them down 0.8% year on year. So those numbers are for the European area. So we see that the demand remains quite low. Generally, costs remain elevated versus previous years. So we've got a higher cost base, and it's keeping those rates a lot higher than 2022. And we also see that as a result, it's causing increased volatility. As an outlook, we generally see that there's less room for large rises as a result of a tight market. We've got some excess supply. However, as I've mentioned a few times, that volatility in the short term can increase because those margins are low and the prices are going to be quite receptive to any cost changes. However, the immediate cost pressure is much lower than we saw in 2022 and even 2023.
Thanks, Nathan. Yes, thanks for sharing your insight there. And just before I show the poll as well, I think we had a couple of questions already come through just about the overall index, which I think is probably worth just addressing so everyone understands. So this isn't, I think that one question just saying, is the value measure 128.9 euros per kilometer? No, this is an index, so it shows the change in both spot and contract prices. Rather than absolute amount. So, and actually, when the other question, when it's showing that contract rates are above spot, you have to think about it as in the contract rates have changed more from their base than spot, really. Thomas, I noticed that you said you might want to answer that question as well. Did you have anything you wanted to add to that about how to interpret the index?
No, thank you.
Yeah.
It was exactly that. Yeah, that was the 128.9. You just need to read it as at the beginning of Q1 2017, it was 100. So the price from Q1 2017 increased by 28.9%. This is how to read the screen exactly.
Yeah, thanks, Thomas. Right, and we've also got our poll results in now. So I've just started sharing those with you. You can see the overwhelming majority are looking at a slight increase really there. But what do you think of that, Thomas? How does that align with your expectations for the next quarter?
Yeah, I like the result because this is exactly what we have in the report and what Nathan was talking about. Here in Europe, we are clearly caught right now between, the road European road freights are clearly caught right now between rising costs and a weak demand for transportations. So the outlook we will see in detail and lane by lane and corridor by corridor. But the global idea is that costs are increasing, and you will see in certain countries increasing quite in a huge amount. And the demand is quite weak, so we don't see a sharp drop in prices. My think is the probability is quite low, so they will either remain flat because of weak demand or start to increase because of cost and demand that is good.
Okay, thank you. Very interesting. All right, let's move on to the next slide. We're going to take a look at some of the supply side issues in the market now. So we'll start off with diesel prices, and Marianne's going to take us through these next slides.
Yeah, sure. So what can we say for the fuel prices evolution for the Q4? At the end of December, we had an average diesel price reaching 1.57 euro per liter, meaning a 4% higher versus September. However, when you see the evolution since notably 2023, we are quite a lot below the peaks we have seen. But then what are the main drivers behind this increase that we observe on the last quarter? In fact, the prices started to increase early October, and it was mainly pushed by the crude oil prices, and which is mainly due to the escalation of the conflict in the Middle East. So the situation in the Middle East having a direct impact on the oil supply disruptions. If now I have a look on the HVO prices, We all know that there are a lot of disparities in the density of HVO refueling stations within the EU, but I think it is interesting to start to give an overview of the prices of on HVO. The Netherlands knows the greatest density, just for you to know as a reminder, and France and Romania had the lowest density. But in the same time, we see a very, I would say, a very sharp increase of number of stations. It was tripled, notably between March and July last year. So in terms of prices, HVO prices are between 0.10 euro per liter and 0.60 euro per liter more expensive than diesel. And this is everywhere except in Italy, where you have subsidies. So HVO and diesel prices have the same level of price. And just to finish on HVO, this is in Germany that you can find the highest price, reaching 2.23 euro per liter. So if we try to look forward, you have a lot of uncertainties. 3 elements in terms of, I would say, points to be monitored. The first one is the OPEC Plus members that could continue to delay the phasing out of the voluntary cuts. Now it is set to start in April this year, 25. The second element is, and Nathan, you already mentioned it at the beginning, the change in the economic growth could significantly change the global oil consumption forecast. So depending on the economical situation in Europe, it will have an impact, of course, on this aspect. And finally, of course, the situation in Middle East, we need to really monitor how it is going to evolve and how much the market is going to remain uncertain and volatile. Maybe if you can go to the next slide, Michael.
Mhm.
Yeah, just let me, because it is linked with the fuel prices in a way, I would like here to have a focus on the ETS2 regulation, because as you know, the European Commission has currently implemented many regulations and directives to accelerate our industry to decarbonize. So you have the CO2 standards for the new vehicles, the Eurovignette directive for the toll, counting emissions for the CO2 reporting, you have the Euro 7. So you have a lot of regulations that have an impact on the total cost of ownership, but they don't impact directly the fuel prices at pump. But however, we will see the integration of road transport into ETS2 by 2027. And ETS2 is the new emission trading system. And we anticipate here an increase in the fossil fuel prices based on the carbon content. And meaning that on the long run, it means less demand for diesel powertrains. So the graph that you see here shows the link between the carbon pricing and the fossil fuel taxation for diesel and natural gas, which is excluding additional value-added taxes that EU, of course, countries might apply. So I will just finish with some key figures based on the tank-to-wheel approach. Burning 1 liter of diesel emits 2.62 kilograms of CO2, while 1 kilogram of natural gas, either LNG or CNG, emits 2.3 kilograms of CO2. So meaning that integrating road transport into ETS2 means that the carbon content of fossil fuel used by the trucks will have a price set by a carbon exchange market, which is starting at a minimum of 40 euro per ton of CO2 with no maximum value. Just to finish on that, HVO is not expected to be affected by such taxation and therefore could become more competitive in terms of price.
Very interesting. Thank you, Marianne. And we'll now move on to an update on the changes in tolls as well.
Yeah, this is the main trend that we observe since last year, which is going to be even more, I would say, a big topic for 2025. You can see on the map that many European members have increased their tolls starting beginning of the year. And you have, so this map is showing you the countries that have already, in a way, officialized the increase and other countries that are going to come. And the map is showing you, in fact, the changes compared to 31st December 24 for Euro 6 Class 1 truck versus 25. And you can see that you had the highest increase in Austria with 11%. Latvia, as you can see, is seeing a price decrease for this specific vehicle, but it is not the case for the older trucks. Portugal partially removed tolls on this highway while it is increasing the price on others. And you can see also an increase for Denmark, which is corresponding to the implementation of the Eurovignette directive. A price hike in tolls is also expected later in 2025 for France, as well as for the Netherlands, Sweden, and Luxembourg. And those countries, in fact, will announce the new CO2-based price differentiation in March this year.
Okay. Thank you. So we'll wait for that in anticipation and see what the magnitude of those increases is likely to be then. All right. Well, we'll now move ahead from those supply side issues really to take a look at some specific lanes and how rates are developing on these. And we'll start off with France, Spain, and Nathan's going to take us through this one, please.
Oh, thank you, Michael. Yeah, so if we look on the graph on this lane, we see that the very contrasting stories really reflect the contrasting stories of the French and Spanish economy over the previous year or so. If we look at the actual changes in rates, we see that on the head haul from Paris to Madrid, so that's the black and the grey lines, contract rates continued to increase. So they increased 3.1% quarter on quarter. How we saw a very significant 5.1% drop quarter on quarter for the spot rates towards Madrid. If we look on the back haul now towards Paris, see that contract rates rose 3.5% and spot rates rose 4.4%, and they're both quarter on quarter. So really, if we consider what the factors are affecting these rates, we can start off on the head haul. So I think the main thing we can see that the contract continues to rise. Now, this is largely due to a strong Spanish manufacturing sector. So the sector has consistently outperformed the EU area throughout second half of 2024. Spanish PMI sat at 53.3 in November, and that marks 11 consecutive months above the 50 threshold for growth. And now the Bank of Spain is expecting a 3.1% growth figure for the economy for 2024. So really what we can see that this activity has increased that medium expectation of volumes that will be volumes of the Spanish industry that will then demand Spanish road freight. And this is causing new contracts to demand larger volumes, adding more demand side pressure and continuing to increase those contract rates. In contrast, we have seen some falls in Spanish activity. Notably, we see that retail fell between the months of July and November. It averaged minus 1.4%. Now that's in contrast to a plus 4.3% in the preceding 5 months. That largely brought down demand side pressure on the spot market, reduced the tightness in the market, and allowed for that significant fall there in the spot market. If we look over towards France, it's a consistently quite quiet demand environment, but we can really see that both markets here were affected by rise of diesel prices in Q4, and that's the large contributor to this large increase in the rates towards France on this lane in both markets. General outlook for this lane, we see that we can expect a significant story, a similar story from France, settled. However, Spain could settle out, and we could see it level out at this higher level, higher costs remain, continued higher demand pressure, and we could expect to see the rates to share this relationship, but show increased short-term volatility, but lower medium-term change.
Thank you, Nathan. Yes, so the Spanish situation possibly not quite as positive as it has been in the past, and it's leading to some falls on rates there. Well, we'll look at another lane now. This is France, Germany, and Thomas is going to take us through the trend here.
Yeah, thank you. And I will also benefit from that to answer one question, that the S is for spots, the C is for contracts. So what you see here are the rates directly for spot and contract. And you see the direct price in comparison with the index that we have seen at the beginning. So here we are on a specific corridor between two specific countries, and you can see the price for FTL, general cargo truck. What we see here between France and Germany, we compared to the previous slide, we here have two economies that are quite sick in Europe, sick in the sense that not going very well. I will look at my notes just to give you some details. The details are all in the report. On order book in Germany, in German industry dropped by 5.4% on a quarter-on-quarter. The demand also of goods was down by 8% year-on-year. So we have weak demand for goods. The industry also is decreasing. The industry output is decreasing. It's the same idea in France also, where we look at the PMI index that is dropping in France too. So we do have weak demand, but if we look at the increase of costs of transportation, they are high, and I will give you some figures on that. But just to see it from a graphical perspective and also from what we get from the market, it seems that we reach the floor path where the costs, the demand and the costs are quite okay with the fact that increasing costs should be passed on to the shipper, in the sense also that the margin of carriers are thinner and thinner, and we begin to see that the weak demand is not a good way of saying that the price will keep dropping. So here, if we're looking at the cost price, we have a plus 2.8% quarter-on-quarter for the tires only in Germany. We have the insurance that increased by 4% quarter-on-quarter, plus 30% year-on-year, which is huge. We have the labor cost also that is plus 5% at the Q3 2024. So for sure, with this high increase in costs, it seems that now this increase in cost push upward on these rates between France and Germany, where the demand for transportation is still weak compared to previous years.
Thanks, Thomas. Yes, very interesting. Okay, we'll move on then to the next lane, which is in this case looking at Poland, Germany, and Marianne's going to talk us through this one.
Yeah, of course, the same trend here. So you can see the prices increase in all directions for spot and contracts. Just to specify as well here that the volume of road freight have decreased by 10% on this lane, if it's in both ways, between 24 versus 23. So on the head haul route from Warsaw to Duisburg, you can see that the contract rates rose by 2.3% quarter-on-quarter, and the spot rate saw a similar increase of 3%. And if you take the year-on-year overview, it means that the contract rates increased by 8%, while spot rates increased by around 9%. If you take the backhaul route from Duisburg to Warsaw, you can see that the contract rates rose by 7% quarter-on-quarter, while the spot rates increased by just 1%, which is, showing a relative stability at 1.44 euro. Compared to the same period last year, spot rates rose by 10% and the contract rates increased by 7%. If you take the global overview on the head haul, the gap has reduced between spot and contract rates slightly, and you can see that the spot rates now are 10% higher than the contract rate this quarter. And in contrast, the gap between spots and contract rates narrowed on the backhaul. So we already mentioned many reasons behind that in terms of factors. Again, the rising costs in Germany and Poland, of course, are putting a lot of pressure on prices, notably driven by the toll increase in the two countries. If you were participating to our last webinars, we were saying that in Germany, since the implementation of the CO2 tolling taxation in December in 2023, the toll increased by around 0.15 euro per kilometer, and a CO2 surcharge of 200 euro per ton of CO2 was added for commercial vehicles. So meaning that the consequence that trucking companies are attempting to avoid Germany. And this is combined, as Nathan said, with a low, I would say, manufacturing sector activity, low performance. In Poland, you have the inflation, which is remaining elevated, which is about 5% in Q4 last year. And you also have to take into account that you have a quite sharp increase of the labor cost in Poland for transport employees, increasing by 16% year on year, which is the second highest increase in the EU after Romania. So as a result, the cost base for Polish operation continues to grow and of course pushing pressure on spots and contract markets. We can say that the domestic demand is recovering slightly. However, the downturn in the new orders failed to offset the falling production output, which is of course limiting the rate growth for spot and contract rate, and the demand is lagging. So overall, rising costs on the Warsaw-Duisburg routes are exerting the pressure on rates, and we believe that the rates are going to remain elevated in 2025, as the profit margins now provide very little room for further falls. And Germany's sharp toll increase, along with the rising labor costs in Poland, are the key contributors for this trend that could continue.
Thanks, Marion. Very interesting cost increases driving these high rates, then theme across a lot of different lanes. So we're going to take another look now at the cross-channel lane, looking at UK France, just to update you on developments here in the overall picture. And Nathan's going to talk us through this one.
Thank you, Michael. Yeah, so it's an interesting lane, has been for the past few years, and is always a rather complicated story. So it involves the same varying demands and rising costs and capacity factors as the other lanes, but then of course we have the addition of Brexit, which, whilst it does feel like that was a while away, we are still seeing continued changes in the regulation, operation, checks, and administration on this lane. So first of all, if we have a look at the actual changes, we see that if we're looking on the head haul towards the UK, contract rates and spot rates fell. So that's an 8.2% fall quarter on quarter in contract and a 6.3 quarter on quarter fall for spot. If we look towards France, they both remain much more steady. We have a small fall in the spot rates, and the contract rates increased slightly by 0.6% quarter on quarter. So if we consider what's affected this, the change in volume on exports out of the UK towards Europe remains rather steady, has not changed significantly, and not adding or reducing much pressure on that lane. If we consider rates towards the UK, if we have a look at latest ONS figures, so that's the UK Office of National Statistics, UK imports from France are now down 8.8% year on year, so significant contributor to that big fall that we saw in quarter four for goods, consumer goods, that is. And that's in quarter four, so less spending and less trade for physical goods between the UK and Europe, as UK consumers are being more careful and can afford less or expensive goods from the continent. So if you consider that also being a quiet French economy and a rather quiet UK economy, we have very little pressure on this lane. However, the complications in terms of the outlook as we look forward to the start of 2025 and we look into the rest of the year, as I mentioned, Brexit still playing a factor. So we've got the delayed border targeting operation model now has come into effect in January 31st. Now this means that medium risk animal and plant products now require additional documentation and checks. And so that's on January 31st. It has been delayed multiple times, but that's now effective. Now this has the ability to increase the costs, increase delays of the administration. So we might see some upward pressure on rates as we start the year. We also can see further ahead, there are more checks due to come into effect in July, so we have more administration, more delays, potentially could increase the pressure on rates. However, generally it's a rather quiet environment. There's little pressure from the demand side on rates, and the rates remain elevated pre-Brexit and pre-2022. So we expect to see some potential for rate increases, but a quiet story.
Thanks, Nathan. Yes, and we picked that lane partly because of the sharp changes in rates that we saw in the last quarter. And that's similarly why we've chosen to highlight the Germany to Austria lane as well. We've seen some quite sharp changes on this particular lane, some of the biggest in Europe. So Marianne was going to take us through this one, please.
Yeah, this line is very interesting indeed. You can see on the graph you have declining prices trend for the spot prices in Q4 versus Q3, and you can observe an increasing trend regarding the contract prices on the same periods. And we can observe that the volume of road freight has been stable on this lane both ways in 24 versus 23. On the head-haul route from Duisburg to Vienne, you can see that the contract rates rose by 8% quarter on quarter. And meanwhile, the spot rates dipped slightly by around 1.5%. And year on year, contract rates are 9% lower than the same period last year, while the spot rates have fallen by about 4%. On the backhaul route from Vienne to Duisburg, you can see that the contract rates in Q4 increased slightly by at least 3% from the previous quarter. And in contract, you have the spot rates that declined by 2%, dropping at 129 euro. So compared to the same period last year, contract rates have risen by 8%, while the spot rates have edged down slightly, decreasing by 1%. And on the head-haul, the significant rise in contract rates narrowed the gap between spot and contract rates to 12% in Q4. So as we saw previously, in Germany, the automotive and machinery sectors remain weak. So of course, it is reducing the export demand, which is translating into lower road freight volumes, which is reducing the customer competition for road freight, which is freeing up more carrier capacity, and so it is resulting into more pressure on freight rates. The German truck operation costs, we mentioned that already, are on the rise. You have the tire costs that are on the rise by 3% in Q4 compared to Q3. You have the maintenance and repair costs that have increased in Germany by 1% in Q4 also versus the previous quarter, and the insurance costs that have increased as well by 4%. In Austria, you can observe the same trend in terms of increasing costs, notably the wages, tires and maintenance costs, and the competitive pressure on the other side have constrained, in fact, the ability to raise freight rates. This is announcing continued challenges for Austria road freight markets amidst the weak manufacturing activity and the limited price growth in the spot rates. What we can say, if we have a little bit an outlook of what could happen, we could say that could be an improvement in new export orders PMI in Germany, which could be coupled with the rise in new orders in Austria, so showing that there is potential for a gradual recovery in export demand. So that could push rates up in the short, medium term as industrial output increase to fulfill orders. So if these trends continue, future road freight volume could gradually rise, reversing some of the downward pressure on the rates we see today. Thank you, Michael.
Thank you, Marianne. Very interesting to think about expectations for the future of that lane with all those volatile changes taking place. All right, and we'll move on to our final rate slide now. And it's, I think, important to remember that we've mostly focused on international rates in this webinar, but Apply does also have data on lots of domestic lanes as well. In this case, we're looking at domestic for Italy as a whole. And Thomas is just going to explain a bit more about this one.
Yeah, so here the graphic is changing a bit. We have a month-to-month index. So here, this is an index back again. The beginning of the index is a 100 base at January 2017, and then you have a month-to-month analysis. What we see over there, and sorry, the white one, the pink one is the spot one, so the S, and the dark one is the contract one. What we see over there over the past months and over the year 2024 is if we leave apart the up and downs, we see a slight increase, plus 2.5% over the year for Italy, domestic Italy, and domestic Italy. Just also let me precise that this is a basket of the main cities, the main in this part where we have a weighted average of these main cities. Plus 2.5% year on year. This is mainly linked also with that the fact that in Italy we have an increase of consumer spending. So and this is different than other countries. We have seen that in Germany, in France, this is not the case. In Italy, we have an increase, and over the 2024, the past year, we had an increase of consumer demand, while we still have a decrease on the industrial side. The automotive sector was quite hit also over 2024, minus 30% in the total car produced by Italy. So the huge decrease in 2024 that has also for sure an impact on the demand for transportation. But still, as many countries, we have an increase in price. The increase in price and the increase in operational cost is a bit lower in Italy than in other countries, especially if we compare it to Poland or Germany. But still, we have this increase. And the demand seems to be a bit stronger, let's say, than the other countries in Europe. Maybe that can explain this slight increase of prices over the past months and over 2024.
Thanks, Thomas. Very interesting to hear about the situation in Italy in a bit more detail. All right. Well, thank you very much to all our panelists for their excellent insights and contributions throughout the presentation there. We're now going to open up to our Q&A session, and I can see we've already got quite a lot of questions that have come through. So we'll try and tackle as many of them as we can, I think. I think perhaps we can start with some of the more sort of methodological ones, just explaining about coverage or different kinds of data included. So, Thomas, I can see you've put your hand up to answer a couple of questions about whether LTL data is available and whether temperature-controlled data is available, that kind of thing. So would you like to just go into that?
Yeah, we do have additional data for sure. We need to pick some here for the webinar, and then Upply is a subscription. You need to have a subscription to have access to all the data. We do have LTL data. LTL data, this is more complex to have a global index on LTL because you have different ways to manage LTL. So LTL for less than truckload compared to FTL full truckload. So this is, yes, we do have data on that. We won't show it in this webinar because here we're trying to capture the big trend with the LTL part. And indeed, we do also have temperature control, bulk, many different kind of transports. The majority of data still the same on general cargo. This is why we pick general cargo for this webinar, but we do have a variety of data to apply.
Thanks, Thomas. Yes. Okay. And Nathan, I can see you put your hand up for another question here from one of our listeners. So having unusual requests for price increases from Polish carriers since the end of December 2024 on the domestic market up to 5 or 8% versus the rest of the country and other EU carriers. What's the cause of this? What do you think, Nathan?
Yeah, I think especially on contracts, this wouldn't really be surprising. I think what we're seeing that we've recognized that we're seeing low margins in the market. There's very little natural pressure from demand to raise the rates upwards. And of course, with many contracts, there needs to be a level of margin in that contract to make it feasible for the year. So I think we're seeing a lot of carriers having to play catch up, having to recognize the ways in which the cost of have increased. And even though we initially saw those large shocks in 2022 and 2023 on diesel, the cost base still remains elevated. And I think we're going to have to see a gradual increase in costs on contracts to, repair and return these margins and make them feasible. So I think even though we're seeing very little demand pressure and what we're seeing, the contract index remains elevated because these need to be priced into new contracts, and we will still see some increases even outside of obvious short-term increases in costs. It still needs to catch up in new contracts.
Thanks, Nathan. And would you like to quickly answer that question about origin and destination points in the UK, France as well?
Yes. So as Thomas mentioned, they are combined and weighted averages, but what we consider mainly here are the largest origins and destinations. So with France, that being Lille and Paris, with Lille being largely affected by manufacturing and Paris being largely consumer and distribution. And then we have Birmingham, which is the Birmingham and the West Midlands region in the UK, which is a centre for distribution centres and manufacturing and warehousing. So they're the main regions if you consider the West Midlands. We also consider a lot of other regions, but West Midlands and Paris and Lille as main indicators for large volumes of demand and volume.
Thanks, Nathan. And we had another question about progress with tachographs and refitting, and we talked about that quite a lot last time, didn't we, Marianne? So, is there any update on that? Oh, you're muted, Marianne.
Can you repeat, Michael? It was cut when you took the floor.
Oh, sorry. We had another question on tachographs and progress
Yeah.
with that implementation. So, is there a
Yeah.
progress update on that side?
Yeah, if you remember, you have some different agendas and deadlines to retrofit the tachograph. You had an initial deadline, which was 31st December 2024, to replace the analog and digital tachograph G1. And there is a new deadline now. IRU has a lot advocate in that direction to retrofit this first generation as of 28th February. So this is the new deadline that all of you need to be aware to retrofit this first, I would say, this initial version of the tachograph. You can find all this different information on IRU Intelligence Platform. You have all the different regulatory updates that we are following on this one.
Brilliant, thank you. And then another question here, just asking, when was the survey undertaken, presumably to collect the rates data, and what is the analysis date? Obviously, politics are all moving daily at present. Thomas, would you like to tackle that one?
Yeah, for sure. Politics is moving quite fast, for sure. And so to answer to your question here, the data that you see are data that are coming from the date of transportation or the date on directly the date of the transportation. So we know that in Q4 2024, the data that we are looking, this is all the shipments that happen in Q4 2024. We stopped the data on the 15th of January, the time of collecting all the data. And from the 15th of January to now, the analysis was done. So it's quite fresh, let's say, and the analysis is done over the last 2 weeks based on data from the past quarter.
Thank you. Yes, and another question, this one for you, Marianne. How big do you consider the impact of new regulations and legislation to be? Open question.
To be honest, all of them have an impact. As I was mentioning on the ETS2, notably regulation, but you have all the different regulation around the county EU on the CO2 reporting, on the CO2 standard, the mobility package. So if you take the pie of the total cost of ownership with the different, I would say, elements of costs such as wages, administrative costs, fuel, etc. All those different regulations have an impact on the operations. On this one, if you want to know more, we have a dedicated briefing on the total cost of ownership per powertrain, and we notably analyze the type of impact depending on the regulations.
Yes. Yeah, lots of detail to go into there, certainly. All right, and then Nathan, we have another question asking about contract prices being higher than spot prices, and why are they? Would you like to go for that one?
Sure. So another opportunity just to reiterate the fact that, of course, on the indexes, they represent a comparison to the first quarter of 2017. But it does also include, if we are seeing the contract index above spot index, it is likely that there are some contributing lanes behind that which show that relationship in the actual euro amount as well. And we are seeing that. And I think the easiest way to explain this is just the fact that we still have that weak demand environment, and that's going to affect that spot index. It's going to be that short-term pressure on the spot index. That's still weak. In some places, it's still falling, and it still has the ability to bring those spot rates down it's a result of excess supply in the market, low demand, and a lot of competition on that supply side. So that's the pressure to pull those down. Below the level at which we would see contract rates drop into, and that's because, as I mentioned before, contract rates need to have a certain level of profit. They need to consider the changing cost environment, and they're going to stay elevated, whereas the spot index can be more reactive and drop below the cost in the short term. So that's really why we're seeing that. It's not something that we'd expect to see. It's a contrast to the natural state of the market, but the conditions have provided that type of environment in multiple lanes.
Yeah, thanks, Nathan. It's really interesting when you see all the data laid out from the applied data sets. You can see those kind of trends and nuances in the market. Endlessly fascinating. All right. Well, thank you very much to our panelists for their answers to those questions. I'm sure there are many more questions to be asked. So if you do want to carry on the conversation with any from the IRU, Apply or TI, please do get in touch with us. We'd be very happy to keep talking to you and answering your questions as best we can. You can use the contact details that you see on your screen there to do so. So thanks again to all of you for joining us for another webinar session today. It's always a pleasure. And thank you very much to the panelists, Marianne, Nathan, and Thomas, for all their views and insights. We look forward to seeing you next time. Bye-bye.